A lot of people are building portfolios right now, specifically to live off the income those portfolios throw off. Not to sell shares, not to time the market, just to collect dividends and use them as a paycheck. It sounds almost too clean, and honestly, for most people chasing this goal, the version they've been sold is a little too clean. So let's talk about how it actually works. The core idea is real and it's documented. Stocks pay dividends. If you own enough of them, those dividends can cover your expenses. The S&P 500 has historically paid a dividend yield in the range of 1.5 to 2% annually, according to data tracked by Robert Shiller at Yale. High dividend strategies, things like dividend growth funds or ETFs that track dividend-focused indexes, have historically yielded somewhere between 3 and 4%. That's real money. But here's where most people make the first mistake. They think about dividend yield in isolation. They see a stock or fund yielding 6, 7, even 8%, and they chase it. The problem is that high yields often come with either slower price growth, higher risk, or both. A fund that pays you 7% while slowly losing value in real terms isn't generating wealth. It's distributing it and sometimes destroying it. Vanguard has published research showing that chasing high yield specifically, without accounting for total return, tends to underperform broad market strategies over long periods. So the goal isn't maximum yield. It's sustainable yield from a portfolio that also maintains or grows its purchasing power over time. Here's how the math actually works. If you need $40,000 a year to cover your basic living expenses, and you're drawing from a portfolio yielding 3%, you need roughly $1.33 million invested. That's a big number. At a 4% yield, which is achievable with dividend-focused ETFs like Schwab's U.S. Dividend Equity ETF or the Vanguard Dividend Appreciation ETF, you'd need about $1 million. These are well-documented, low-cost instruments. This isn't speculation. Now, $1 million sounds like a lot, and it is, but the path to it is well-worn. Someone investing $1,500 a month into a broad dividend growth fund, earning a historical average total return around 8 to 10% annually, which is consistent with long-run U.S. equity market returns documented by sources like Dimensional Fund Advisors, could reach that milestone in roughly 20 to 25 years. That's not a promise. Returns vary. Sequence of returns matters enormously. But it's not fantasy either. It's math applied to documented history. The other thing most people get wrong is the tax picture. In many countries, dividends are taxed as income, sometimes at your full marginal rate. In the U.S., qualified dividends are taxed at lower capital gains rates, but only if you meet holding requirements. This is worth understanding before you structure your entire strategy around dividend income, because the account type you use, taxable brokerage, Roth IRA, traditional IRA, changes the outcome significantly. Morningstar has covered this in detail. The short version is, dividend income inside a Roth IRA is tax-free. The same income in a taxable account may not be. So the strategy that actually holds up looks like this. You build a diversified portfolio, probably a mix of broad market index funds and dividend-focused ETFs. You reinvest dividends while you're accumulating, you let compounding do the heavy lifting, and you only switch to drawing income when the portfolio is large enough that the yield covers your expenses without requiring you to sell shares in a downturn. The first step this week is embarrassingly simple. Open a spreadsheet, write down your annual expenses, divide by your target yield, use 3.5% as a conservative middle ground. That number is your portfolio target. Now you know what you're building toward, and you can reverse engineer a monthly savings rate to get there. Most people never do this calculation. The ones who do tend to actually make progress.